Closing costs are extra purchase expenses. They are the fees and charges needed to complete the property transfer. Concrete case. A buyer saved the down payment but forgot thousands in fees. Budget beyond the price. The simplest check is an early closing estimate and separate cash reserve because it replaces guessing with something observable. Loan origination, processing, underwriting, and application fees may apply. Concrete case. A mortgage quote includes charges separate from interest. Borrowing has setup costs. For a real choice, ask for lender fees, appraisal, title work, taxes, insurance, escrow, recording fees, and transfer charges early. You can spot it when a mortgage quote includes charges separate from interest. Banks often require a value check before funding. In practice, a high offer can stall if the appraisal comes in low. Local details often matter more than broad market averages. A safer property decision checks more than the monthly payment. Trouble starts when mortgage approval does not guarantee enough cash to finish the purchase. This starts with title search protects ownership. Title work checks whether the seller can legally transfer the home. Concrete case. An old lien can delay closing. The cost lands somewhere because a buyer can afford the loan and still be surprised by closing day fees. The same situation feels less confusing once the cause is named. Title insurance reduces risk. Some places use insurance against hidden title defects. Case. A previous paperwork error may appear years later. Protection has a cost. Inspection costs are separate. Buyers may pay inspectors to identify defects before final commitment. Picture. A small inspection fee can reveal a costly roof issue. Due diligence costs money but reduces surprises. Early clarity can prevent a rushed or emotional decision. Taxes and recording fees. Governments may charge transfer taxes, stamp duties, or registration fees. Picture. The same home can close differently across locations. Local rules change totals. Here, a buyer saving the deposit but missing cash for signing day shows why lender fees, appraisal, title work, escrow, tax, and insurance matter more than a broad label. Buyers may prepay insurance, property taxes, or interest. Real case. Closing near month-end changes prepaid interest. Timing affects cash needed. Local details often matter more than broad market averages. A safer property decision checks more than the monthly payment. Some lenders collect reserves for taxes and insurance. In practice, the buyer funds an account before bills arrive. Monthly obligations start early. The outcome matters because loan approval and closing cash are two different tests. A buyer saving the deposit but missing cash for signing day. Agent commissions may be embedded. Depending on market, seller-paid commissions can influence price or negotiation. Seen when. No fee is truly invisible if it affects the deal. Understand who pays what. The issue becomes concrete when no fee is truly invisible if it affects the deal. Buyers can pay up front to lower interest rate. Local details often matter more than broad market averages. For the actual decision, ask for lender fees, appraisal, title work, taxes, insurance, escrow, recording fees, and transfer charges early. A seller may agree to cover some buyer closing costs to complete the deal. This often happens when a buyer has enough income for the mortgage but limited cash left for fees. A seller credit can reduce the buyer's cash due at closing without changing the headline price as much. The important point is that closing costs are negotiable in some deals, but they are still real costs that must be planned before the final signing appointment. Estimate versus final amount. Early estimates can change before closing. Think of a buyer should compare the final disclosure line by line. The impact is concrete because mortgage approval does not guarantee enough cash to finish the purchase. The market reaction often depends on details that averages hide. The facts are easier to sort when read when appraisal fee is treated as evidence, not background noise. This is the total money needed, including down payment and costs. In practice, a buyer approved for the loan may still lack cash to close. Liquidity can stop a deal. The practical cost appears because a buyer can afford the loan and still be surprised by closing day fees. The weak spot appears when the purchase can stall if extra cash is not reserved for closing. The easiest mistake is to ignore lender charges because it looks minor until recording fees makes the cost visible. Refinancing has closing costs too. New loans can carry fees even without moving. Imagine a lower rate is not automatically better after costs. The market reaction often depends on details that averages hide. Investors include costs in returns. Closing costs reduce profit on flips or rentals. Daily version. A small margin deal can turn weak after fees. Returns must include entry costs. The risk is not abstract because loan approval and closing cash are two different tests. Closing costs matter because they arrive at the exact moment when the buyer thinks the main negotiation is finished. Buyers should request itemized estimates and challenge unclear fees. Imagine a confusing line item deserves explanation before signing. The stakes show up because mortgage approval does not guarantee enough cash to finish the purchase. The market reaction often depends on details that averages hide. The pressure shows up when a confusing line item deserves explanation before signing. Closing costs also protect the transaction by checking title, value, lending risk, insurance, and legal transfer. Closing costs matter because they turn the advertised home price into the actual cash needed to complete the purchase. Fees, taxes, insurance, legal work, lender charges, and prepaid items can surprise buyers who only saved for the down payment. A realistic budget includes the cost of entering the deal. The issue becomes concrete when they can change affordability even when the price looks manageable. A buyer who saves only the down payment can still be short at closing because many smaller charges arrive together. Closing costs are the fees and prepaid expenses that turn an accepted offer into a completed property transfer. Appraisal, title search, lender charges, government recording, insurance, taxes, and escrow deposits can all arrive near the end. Closing costs are the part of buying a home that often feels invisible until the final documents arrive. A buyer may save carefully for the down payment, choose a home, and then discover that signing day also needs cash for lender fees, appraisal, title work, insurance, taxes, and prepaid items. That is why closing costs should be planned from the start. They are not random extras. They are the transaction costs of transferring ownership and completing the loan. The safest way to think about closing costs is simple. The purchase price tells you what the home costs, but closing costs tell you what the deal costs to complete. A buyer who budgets only for the down payment may feel trapped at the end. A buyer who asks early for a written estimate has more control. Before choosing a home, compare the down payment, closing costs, moving costs, repairs, and first-year ownership expenses together. A simple request for a full closing cost estimate early in the process can prevent a buyer from confusing approval for a loan with readiness to close the transaction.